Hello and welcome to Money Matters. I'm your host, Kelly Lemon.
And I'm Ty Genwright. Here's what's coming up. Twitter storm. Boss Jack Dorsey confirms that 4 senior executives are leaving in a tweet.
Also ahead, the darling of Davos has IMF Director Christine Lagarde schmoozed her way to a second term.
Plus, is your job under threat from technology? We take a look at the industries most likely to be impacted by automation over the next 20 years.
First to our top story, in that management shake-up at the very top of Twitter. It's been announced 4 executives are to leave the company.
Well, Twitter's stock has fallen by nearly 50% since its former chief executive returned to the job last year and is now trading below its IPO price. With just over 300 million users, it saw its slowest user growth last year and was even overtaken by the photo-sharing app Instagram. Well, for more on this story, let's speak now to TRT World reporter Laura Francis, who is in our newsroom. Laura, has this decision, these resignations, come out of the blue, or were they expected?
Well, these executive departures are the biggest changes since Jack Dorsey returned as CEO mid last year, and it really is a major upheaval for the company. Has it come out of the blue? Well, in an earnings conference call in October, Dorsey spoke about hiring and investing in talent and the need for bold rethinking. So this seems to be part of an ongoing reshuffle at Twitter. Some staff appear to be leaving under pressure and some at their own will. Now, Dorsey has addressed press rumours saying that he was sad that the heads of media, products, the engineering division and HR had chosen to leave the company. And as you mentioned, it has been an incredibly tough year for the company. They've failed to significantly expand their user base, so it's not entirely surprising that there are changes of this magnitude.
So what more do we know about the reasons behind this decision? Jack Dorsey briefed the public in a 140-character tweet. Has he said anything else?
Well, they're trying to keep the announcements as positive as possible despite the situation. As you said, the CEO has taken to Twitter to actually praise the executives, saying they're absolutely amazing. They're also trying to reassure staff and investors about the stability of the company by saying that their Chief Operating Officer and Chief Technical Officer will be taking on additional responsibilities. However, Dorsey is yet to lay out a detailed plan of his future plans for Twitter.
Laura Francis, thank you very much.
Now, there's a big week of central bank action ahead of us. The US Federal Reserve is holding a policy meeting on Tuesday and Wednesday, and bank watchers will be looking for hints about another interest rate hike. The Bank of Japan meets on Thursday and Friday with speculation that Tokyo could try to stimulate the world's number 3 economy. But at least we've had a more positive start to the week on markets, at least in Asia.
Well, Asian shares have moved further away from the 4-year lows that were hit last week, with Shanghai stocks adding 1%. That's after a cold spell in parts of the northern hemisphere has helped push oil prices higher and relieved some of the bearish pressure on global markets. Also good news for Tokyo's Nikkei, which slumped to a 1-year low last week. It rose 1.2% in trading today. European markets, though, are off to a slightly bumpier start.
Well, for more on all the market action at the moment, we're joined by Chris Beecham, Senior Market Analyst at IG. Chris, thanks for joining us. The Fed meeting this week after December's rate rise. We were looking forward to a year of 1 or 2 more. Is that still on the cards?
Good morning. It seems increasingly unlikely. Market pricing suggests that they'll hike just once more this year in September. And you have to look at this really. Where are we now from compared to where we were in December? We've got the oil price down heavily from where we were just at the end of last year. Economic turmoil in China as well, fresh volatility across the board in markets. So the Fed will have to take that into account. Now, I think it's probably too early for them to start rowing back really on that commitment or that suggestion of 4 rate hikes in the coming year. But I think we'll start to see the hints of a slightly more cautious approach to the outlook for higher rates.
Now let's talk about the Bank of Japan. After so many efforts to revive the Japanese economy's growth, do you get a sense that it's firing blanks?
It does get more and more of an uphill task, I think, to get the Japanese economy moving again. Of course, it doesn't help that they're still thinking about implementing a new consumption tax. Remember what happened the last time that happened. They were forced to do more to really offset the impact of that. So they do make life difficult for themselves. But nonetheless, they have to continue to step up this easing program. The onus is very much with the central banks at the moment, with the ECB, with the Fed and the BOJ to really say, look, we've got this. We aren't going to start getting too carried away either with tighter monetary policy or less loose monetary policy. And that is really the focus and what stock markets and investors are waiting for at the moment.
Now, Chris, let's have a quick look at oil. After all the turmoil we've had, some confident forecasts from the industry leaders about prices rising again later this year. Do you share that view?
Talk about wishful thinking. I think we've heard some remarkable predictions from Davos. Some people are saying $50 of oil per barrel by the end of the year. Some are saying $5. I think it's really very hard to tell at this moment, as it always is, really where the price will go. We have seen, of course, that strong bounce that's coming off this morning. Hedge fund short positions dropped back at the end of last week thanks to that sharp snapback rally. And really, when we got down to those lows of last week, it was almost inevitable that we'd see this kind of move just start to develop. And I think that's something we might see continue. Remember, if you look back at last year, January 2015, we did have a sort of steady rise in the first month, and then it held for a while before the next big move lower. So seasonality at the moment favours, I think, oil moving higher in the next few months, and then I think it does start to move lower once again.
And staying with oil, Chris, when oil rebounds, will markets too?
Well, essentially at the moment, market correlations go up during periods of high volatility, but it's been fairly said that most people aren't really trading the FTSE or other indices at the moment. They're just trading what happens in the oil price. And that's, if you like, the key barometer at the moment of global demand and the health of the global economy. And we've seen that this morning, indices weaker on the back of that big move downwards in oil in the immediate sort of first couple of hours during the morning session. So I think oil continues to dominate. I struggle to remember the last time we focused so much on crude inventories every week from the US.
Chris, thank you very much for your time for the moment. You'll be back with us later on in the show.
Now to some of the other top business stories making headlines today, and Google has agreed to pay $185 million in back taxes to the British government. This after a probe by its tax authority, which has challenged the company's low tax returns since 2005. But the settlement's been criticised by opposition lawmakers and campaigners who say it's not enough. Google, which is now part of Alphabet, has been under pressure in recent years over channeling most profits from its European clients through Ireland to Bermuda, where it pays no tax on them.
Europe's biggest industrial group, Siemens, has reportedly agreed to a $1 billion in cash to buy CD Adepco, a private-held US engineering software firm. The deal could be confirmed as soon as today. New York-based CD Adepco makes computer programs used by engineers to stimulate the inner workings of an engine.
The German sportswear brand Adidas is ending its 11-year sponsorship deal with the International Association of Athletics Federations almost 4 years early. The BBC reports the decision by Adidas, which is World Athletics' biggest sponsor, is a direct result of the doping and corruption scandal that emerged last year.
Now, as we reported earlier, a bump in the price of oil may be helping out markets today, but the slide still has far more reaching effects. Russia's ruble in particular is now slumped to a new record low.
It seems, though, that the Kremlin is in denial. President Vladimir Putin says he does not have any emergency meetings planned over how to cope with the collapse in the ruble and the oil price. Grace Pascoe reports.
Commodity-dependent Russia is feeling the pain of low oil prices. When its currency slid to an all-time low of 86 rubles per dollar, it was mirroring falling oil prices. But despite recent tumbles, the Kremlin has denied the currency is collapsing.
What you desperately need to see from the Kremlin, rather than deny that the ruble is in trouble, is to be talking about how they're looking to use the revenues that they've built up, or indeed access capital markets right now, to invest in a diversified range of industries that enables the Russian economy to put on a more secure footing.
But the question everyone wants to know is, do oil prices have further to fall?
It's very difficult to call a bottom in such a market as this. I think we're getting now very, very close.
Russia's 2016 budget assumes oil will sell for $50 per barrel. But with oil dipping below $30 per barrel recently, government spending power is being impacted. And that could mean some unwelcome changes ahead.
The government pledges not to cut down social expenditures, but I don't think it can do this. And already the talk is that taxes will have to go up. This is inevitable. And all kinds of other measures will be taken that will affect people's lives directly. This on top of the reduced incomes and growing inflation already.
Many Russians are already stocking up on dollars. And now the country's deputy finance minister says it will look at introducing hedging to protect the country's oil earnings against further price drops.
Let's go back for more analysis now with Chris Beecham from IG. Let's talk about Russia first, Chris. Vladimir Putin not willing to admit that he's got a crisis on his hands, but few other countries have as great a crisis given the collapse in oil price than Russia.
Yeah, I think Russia is certainly not alone in its problems. The difference there is that Russia has far greater ambitions than, say, the likes of Venezuela. We've seen the rhetoric step up from Putin over the last couple of years, obviously his actions in Ukraine and Crimea, now the intervention in Syria. So all this is a sort of symbol of Russian assertiveness, but it's built on very shaky foundations, with inflation continuing to rise and the ruble continues to go down. I think that makes life increasingly difficult for this more aggressive Russian, dominant Russian foreign policy.
Shift gears, talk about Google, another global giant of a different kind. That £130 million, $185 million tax settlement they made with the British tax authorities. Were you surprised by that number? Did you think it might be bigger?
I think, yes, if we looked at Google's revenues, we'd wonder where all that money, why there wasn't more of that forthcoming. And of course, it's these sweetheart tax deals that have been such a feature of UK tax laws over the past few years. And that does make life difficult for the government and for Google. But I think the message that certainly the Chancellor's been keen to send is that actually, yes, we do deal with people who evade tax. We do make them pay. But if you come to Britain, you get a lower tax than, say, in other parts of Europe. So the whole theme is to sort of both give a sop to public opinion in the sense that we are going after tax offenders, but also without a sort of damaging Britain's image abroad. So far, he's treading that line quite nicely, but I think there'll be more to come on this subject.
Chris Beecham, we'll look forward to hearing more from you on a later date, but for now, thank you for today.
Still to come, the future of business, how industry is set to be transformed by automation technology. But what does that mean for jobs?
Now, the World Economic Forum has wrapped up in the Swiss resort of Davos for another year, with Europe at the top of their leaders' lengthy list of worries. They remain divided, though, in their approach to the refugee crisis at a time when the bloc faces a host of other threats, from Islamic extremism and the rise of far-right populist politicians, not to mention, of course, a potential British exit from the European Union.
And there was also fierce debate over global growth and inequality. TRT World's Angeline Ong is in Davos and sent us this report.
If there's one theme that's dominated in Davos this year, it's got to be the fourth industrial revolution, the rise of the robots, digitization, and how that's going to change our lives forever.
You never thought about bringing in solutions where you can actually make a global taxi service, for example, like Uber. That was totally impossible. That's the biggest disruption we're going to see. And it's going to happen in any industry.
There's two key themes that really struck me. One was the pace of disruption. If you look at horse cart to cars, that took hundreds of years. You look at the Encyclopedia Britannica to CDs, that took maybe 30, 40 years. If you look at the pace of disruption now, from checks to PayPal to Apple Pay, it's going just increasing constantly and accelerating constantly.
While the pace of technological change is expected to accelerate, the slowdown in Chinese growth is not seen reversing anytime soon. China's economy, say delegates, is transitioning, not derailing.
You know, when you have a country that's gone through such an amazing amount of growth, there's naturally going to be periods of slowing growth. In fact, I would argue in the year ahead, you're going to see slower growth out of China. Having said that, what we deliver are solutions that help companies be more efficient.
Europe's migrant crisis, rising global security threats, and the erosion of privacy also got plenty of airtime this year. Of course, it wouldn't be a World Economic Forum without fierce debate over global growth and equality, and how the two are linked.
If you don't have the core beliefs that are driving your culture, an inclusive culture, the outcomes are going to be the business, and there's data that shows the business isn't going to be as successful. The thought leadership, the leadership doesn't surround themselves with that diversity of thought.
So far, in many countries, women entrepreneurs are shut out of having access to finance. So they can't grow their companies because quite often the banks are asking for collateral that's in the hands of men. So we need to reorient the way these banks think.
As always at Davos, the call for fairer and more inclusive growth is crystal clear. But whether or not it'll lead to concrete changes remains hazy.
Now, we'll be talking about robots in just a moment, but staying with Davos, and one of the many high-profile guests at Davos was, of course, the International Monetary Fund's Managing Director, Christine Lagarde. She's just launched her campaign for a second term at the helm of the IMF with no obvious challenges. But will a long-running business scandal stand in her way? Kirsty Bassett reports.
The global economy is as volatile as ever, but that's not stopping Christine Lagarde from throwing her hat in the ring for a second term as Managing Director of the IMF. She already has the backing of France, Britain, Germany, China and Korea, which may deter anyone else from applying for the top job. Panmure Gordon, Simon French.
She inherited an IMF that was in a bit of crisis after Dominique Strauss-Kahn's departure. She steadied the ship. She's also played a very, very clever game regarding brokering alliances.
But her role over the 2008 payment of some €400 million to businessman Bernard Tapie continues to hang over her. Last month, a French judge ordered her to face trial for negligence, but Lagarde says she'll appeal.
It's a worry, isn't it? But there is an ability for politicians, particularly the French background, to navigate public office while also dealing with challenges at home. I haven't seen anything yet that suggests that this is something that's going to derail her time at the IMF.
If she is returned to the top job, there'll be plenty of other challenges, not least weak global growth and the Greek debt crisis.
I see less of the risk from the legal challenges going on in France, much more the role of the IMF almost facing off to the European Union and the ECB in the next stage of the Greek debt crisis.
French candidates have held the top job at the IMF for almost 40 of the last 70 years.
Well, TRT World reporter Francis Maguire has just come back from Davos. Francis, what was the mood like regarding Christine Lagarde? Do you think she has got a second term sewn up?
Well, as you say, she's certainly heated things up in the very cold mountain resort of Davos. And it looks like it's going to take a lot to stop Lagarde from winning that second term in charge at the IMF. As we heard in Kirsty's report, she's already got support from some of the big hitters like Germany and France. The UK's George Osborne came out and said she's the woman to help steer the global economy through the years ahead. The Italian finance minister also touched on some of the crises she's dealt with in Europe since taking over at the IMF in 2011. Greece is probably the highlight of that. Now, she's also caught everyone's ears in Davos with her comments about China. As we know, the Dragons had a terrible start to the year. Lagarde warned that markets needed more clarity and certainty about China's leaders, how Chinese leaders are managing their currency. But she also reassured investors by saying they could trust China's official growth data. Of course, there's one big thing that could get in the way of Lagarde. She's been told to stand trial in France over a €400 million payment that was made by the French government to the tycoon Bernard Tapie. That came at a time when Lagarde was the French finance minister. She says she'll appeal that. And she's also going to have to convince the IMF board to keep lending money to Greece in its third bailout programme before the end of her term in July. If she can survive the politics of that, there's a very good chance we'll be seeing Lagarde in the mountains of Davos once again next year.
Francis Maguire, thank you very much.
Now, here's a question you won't want to ask yourself. Will a robot eventually take your job?
Well, it might sound like a futuristic fantasy, but there are many roles taken over by robots already, of course, who don't need holidays, breaks or compassionate leave.
In fact, Deloitte has done a study and found that over the next 10 to 20 years in the UK alone, 35% of jobs have a high chance of being automated.
The sectors facing the most change are wholesaling and retail, with Deloitte finding that 56% of the total current workforce could be automated in the next 2 decades.
Now, an even more dramatic shift is forecast in the transport and storage industries, where it's predicted 74% of jobs could go to robots.
Well, to tell us more about the findings, we're joined by Angus Knowles-Cutler. He's the Vice Chairman at Deloitte, the company behind this research. Thank you very much for coming into us. Your report already says that the impact of automation has been apparent in jobs and in wages for quite some time now, since 2001. Just explain for us how that is.
So what we found, just looking back to over the last 15 years, is that technology, so that's automation, computers, robots, in Britain, has destroyed about 800,000 jobs. On the other hand, actually, it's helped create about 3.5 million jobs. So net, we can say that in this country, it's been a real positive, it's been a real benefit. And in fact, what we've also found is that the jobs that have been created pay about $15,000 a year more than the jobs that they've replaced. So it's been about a $200 billion benefit to the UK economy. The sort of jobs that have gone are clerical, administrative, low-skill manufacturing jobs. Jobs that have been created have been technology, creative industry and caring jobs.
Now, your report says that the evidence of automation has been, we've seen since 2001. What more can you tell us about that?
So the kind of work we've done is actually looking at government statistics and looking at 370 different kinds of jobs to see exactly what has happened to them. Now, we've also looked further back in British history and found that this pattern's continued, that what we found is kind of dangerous, unpleasant jobs, boring jobs, frankly, have actually been replaced by technology, and the jobs that have been created have been better jobs.
I guess the difficulty is, though, for the government, for example, you know, if most of the jobs that are being replaced are low-skilled, if you're not able to upskill the people who were filling those jobs, well, then you've got a problem there, haven't you? Because there's not going to be that seamless transition, is there?
That's exactly the challenge. So what we can say is that history says Britain has moved to being a relatively high-skill economy with more than about half the workforce now being graduates, which is kind of where you want to be. If we carry on the pace we've been going, we're probably in good shape. The big unknown, the big $64,000 question is, are things accelerating? If things go faster, technology becomes more accelerated, which we think it is. Adoption of the technology becomes quicker and it gets cheaper. We're in a whole new territory. And if we are in that territory, it's going to take government policy, educators, and particularly business to actually work together in the face of this big challenge.
Now, do you think workers, in terms of retraining, getting themselves ready for this technological shift, are really doing enough at the moment?
I think it's a really good question because it's to do with government and business and educators, but it's also down to the individuals. And we've talked for a while about people having 3 or 4 career shifts in their working life. I think that's becoming a reality. So people will have to be more flexible, and the education system will have to train people when they come into the workplace from school, but be ready to retrain and retrain people, and people are going to have to be ready for that and know it's coming. Based on what you have looked at, are there any areas which you can say, definitely no robots here, that'll never be infiltrated by the androids? Oh, TV presenters. I wouldn't say that, but I mean, the sort of jobs that are the safest are the jobs which are interpersonal jobs, which are human-to-human jobs, so caring jobs. Education is pretty safe. Sales, creative jobs are safe as well. The jobs that are high risk are jobs clearly that machines can increasingly do, and the risk is that that machines are eating their way into traditional white-collar jobs. And what our work also says is that jobs that pay $50,000 or less today are 5 times more likely to go because of technology than jobs that pay $150,000 or more. There you go. Interesting times. Angus Knowles-Cutler from Deloitte, thank you very much for coming in to talk to us. Now, we talk about Asian markets every day, particularly the world's second largest economy, China. But of course, as the slowdown there continues, we're seeing a race to get money out of the country. But where is that money going, and why does Beijing seem reluctant to stop the outflow? Tara Joseph sent us this special report from Hong Kong.
Sparkly and rare pink diamonds, one way China's spooked investors are trying to keep growing their wealth. As the country struggles with a slowing economy and a sinking yuan currency, wealthy Chinese are seeking ways to get their money out of the country. And the stream of money leaving is starting to turn into a rush. This is a city that has served as a key destination for Chinese money. Investors from the mainland pouring funds into newly constructed apartments, art, and even wine. But now this is just one point on the Chinese investment trail, and it may be hard to stem the tide. Dear customer, we ran out of Thai baht, Australian, and US dollars today, says this photo of a bank sign posted on social media. Even tourism is playing a role, with investors spending big on trips abroad. Recent reforms have made it easier for China's investors to shift money offshore, and Beijing is reluctant to step in to stop the flow. They want to encourage local companies to buy overseas. But as the money pours out, Beijing's worried there will be less to go around back home. The country needs its own citizens to spend and invest at home to renew an economy that is moving at its slowest pace in 2.5 decades.
That's all it is. Almost it from us, but before we go, a reminder of our top stories. 4 senior Twitter executives are leaving the company, the biggest leadership change since Jack Dorsey returned as chief executive. Twitter stock has fallen by nearly 50% since Dorsey's return last year and is now trading below its IPO price amid concern the company has failed to significantly boost its user base.
Google has agreed to pay £130 million in back taxes to the British government after a probe by its tax authority, which had challenged the company's low tax return since 2005. The settlement has been criticised by opposition lawmakers and campaigners who say it's not enough.
And there's been a more upbeat start to this week on the markets ahead of the US Federal Reserve's policy meeting on Tuesday and Wednesday, when bank watchers will be looking for hints about another interest rate hike. The Bank of Japan also meets this week with speculation Tokyo could try to stimulate the world's number 3 economy.
That's it for now. We'll be back later in the day with the top business stories making headlines around the world. I'm Kelly Lemon.
And I'm Ty Genwright. You've been watching Money Matters. Thank you very much for your company. And we do hope to see you again later. Till then, goodbye.
Bye.